Imagine a world where unseen forces shape our economies, influence policy decisions, and impact our daily lives. These forces aren't governments or multinational corporations, but something far more elusive: hedge funds. These financial powerhouses operate behind the scenes, their actions rippling out to touch every corner of the globe. From Wall Street to the smallest developing economies, the influence of hedge funds is profound and pervasive. But what exactly are these entities? How do they operate? And more importantly, how do they wield such significant power? In this exploration, we're going to decode the mysteries of hedge funds, unravel their strategies, and reveal their unseen power in the global economy. So, buckle up and get ready for a deep dive into the fascinating world of hedge funds. This journey will change the way you look at the global economy and the forces that drive it. In the world of finance, hedge funds have carved out a unique and influential role. To fully understand their impact, it's essential to first grasp what they are, how they operate, and the various types they encompass. Hedge funds are investment vehicles that pool capital from accredited individuals or institutional investors and invest in a variety of assets, often with complex portfolio construction and risk management techniques. Unlike mutual funds, hedge funds are not subject to some of the regulations that are designed to protect investors, which allows them to pivot their investment strategies swiftly to capitalize on market opportunities. The structure of a hedge fund is typically a limited partnership where the fund manager is the general partner and the investors are the limited partners. The fund manager makes all the investment decisions and is responsible for the fund's performance. The investors, on the other hand, provide the capital and have limited liability. They can lose their investment, but no more than that. Hedge funds operate by raising money from investors and then investing it according to a predefined strategy. The strategies used by hedge funds are diverse and can range from long, short equity, where the fund buys stocks it expects to increase in value, and short stocks it expects to decrease, to global macro, which bases its holdings primarily on the overall economic and political views of various countries, or arbitrage strategies, which attempt to exploit price differences for the same asset in different markets. One of the key characteristics of hedge funds is their ability to use leverage or borrowed money to amplify their returns. While this can lead to significant gains, it can also result in substantial losses, making investing in hedge funds a high-risk, high-reward proposition. Hedge funds also play a crucial role in investment diversification. Because they can invest in a wide variety of assets and use different strategies, they can provide a level of diversification that is hard to achieve with traditional investment vehicles. This diversification can help to reduce risk and potentially enhance returns, making hedge funds an attractive option for investors looking for ways to diversify their portfolios. Summed up, hedge funds are complex investment vehicles that offer high potential returns but also come with significant risks. Their ability to use leverage and invest in a wide variety of assets allows them to play a unique role in the financial markets, contributing to market efficiency, liquidity, and diversification. Understanding the nature and operation of hedge funds is the first step in decoding their unseen power in the global economy. The influence of hedge funds on Wall Street is profound and multifaceted. They contribute significantly to the liquidity and efficiency of financial markets, play a crucial role in price discovery, and have been at the center of some of the most significant financial activities on Wall Street. Hedge funds, with their vast resources and diverse investment strategies, contribute to the liquidity of the financial markets. Liquidity refers to the ease with which an asset or security can be bought or sold in the market without affecting its price. By actively trading a wide range of assets, hedge funds help ensure that there are always buyers and sellers in the market, which enhances liquidity. This liquidity is vital for the smooth functioning of the financial markets, as it allows investors to enter and exit positions easily. In addition to enhancing liquidity, hedge funds also contribute to the efficiency of financial markets. Market efficiency refers to the degree to which market prices reflect all available and relevant information. Hedge funds, with their sophisticated analysis and high-speed trading capabilities, are often at the forefront of incorporating new information into market prices. This rapid incorporation of information helps ensure that market prices are fair and accurate, which is a key aspect of market efficiency. Hedge funds also play a crucial role in price discovery, which is the process by which the price of an asset is determined on the open market. Through their trading activities, hedge funds help to establish the prices of a wide range of assets, from stocks and bonds to commodities and derivatives. This price discovery process is essential for the proper functioning of the markets, as it ensures that asset prices accurately reflect their underlying value. The impact of hedge funds on Wall Street can also be seen in some of the most significant financial activities. For instance, hedge funds have been involved in major mergers and acquisitions, corporate restructurings, and other significant financial transactions. They have also been known to take large positions in companies, influencing their strategic direction and corporate governance. However, it's important to note that the influence of hedge funds is not always positive. Their high-risk strategies can lead to significant market volatility, and their activities have been implicated in several financial crises. For example, the collapse of the hedge fund long-term capital management in 1998 threatened to destabilize the global financial system and required a bailout by other financial institutions. The influence of hedge funds on Wall Street is significant. They contribute to market liquidity and efficiency, play a crucial role in price discovery, and are involved in major financial activities. However, their activities also carry risks, and their influence can sometimes lead to market instability. Understanding this influence is key to decoding the unseen power of hedge funds in the global economy. The global impact of hedge funds is as significant as their influence on Wall Street. They play a crucial role in shaping global economic trends and have been key players in several economic crises. Moreover, their influence extends to developing economies, where they can have both positive and negative effects. Hedge funds, with their vast resources and global reach, have the ability to influence economic trends on a global scale. Their investment decisions can drive market movements, affect exchange rates, and impact the economies of entire countries. For instance, if a large hedge fund decides to invest heavily in a particular country or sector, it can drive up prices and stimulate economic activity. Conversely, if a hedge fund decides to withdraw its investments, it can lead to price declines and economic slowdowns. Hedge funds have also been key players in several economic crises. During the 2008 financial crisis, for instance, hedge funds were heavily involved in the trading of mortgage-backed securities, one of the key factors that led to the crisis. When the housing market collapsed, many hedge funds suffered significant losses, which contributed to the overall instability of the financial system. However, some hedge funds were able to profit from the crisis by betting against the housing market, demonstrating the diverse and complex strategies that these funds employ. The influence of hedge funds extends to developing economies as well. On the positive side, hedge funds can bring much-needed capital to these economies, investing in businesses, infrastructure, and other projects that can stimulate economic growth. However, their activities can also lead to instability. For instance, if a hedge fund takes a large position in a developing country's currency and then decides to sell, it can cause the currency to depreciate rapidly, leading to economic turmoil. Furthermore, hedge funds can influence policy making in developing economies. Given their significant financial resources, hedge funds can exert pressure on governments to implement policies that are favorable to their investments. This can lead to changes in economic policy, regulation, and even political dynamics. Overall, the global impact of hedge funds is significant and multifaceted. They influence global economic trends, play a role in economic crises, and have a significant impact on developing economies. Their activities can stimulate economic growth and contribute to market efficiency, but they can also lead to instability and influence policy making in ways that may not always align with the broader public interest. Understanding this global impact is a crucial part of decoding the unseen power of hedge funds in the global economy. The unseen power of hedge funds lies in their indirect influence on the economy, their role in policy making and regulation, and their influence on other financial institutions and markets. Hedge funds, with their vast resources and sophisticated strategies, can have a significant indirect influence on the economy. For instance, their trading activities can affect the prices of a wide range of assets, from stocks and bonds to commodities and derivatives. These price movements can, in turn, affect the wealth of individuals and institutions, consumer spending, business investment, and other key components of the economy. Moreover, hedge funds can influence the economy through their role in policy making and regulation. Given their significant financial resources and expertise, hedge funds can exert influence on policymakers and regulators, advocating for policies and regulations that are favorable to their interests. This can include policies related to taxation, financial regulation, trade, and other areas that can have significant economic impacts. Hedge funds can also influence other financial institutions and markets. For instance, they often interact with banks and other financial institutions as clients, counterparties, and competitors. Through these interactions, they can affect the risk-taking behavior of these institutions, their lending activities, and other aspects of their operations. Similarly, hedge funds can influence financial markets through their trading activities, affecting market liquidity, price discovery, and volatility. In addition, hedge funds can have a significant influence on corporate behavior. They often take large positions in companies and can use this ownership stake to influence corporate decision-making. This can include decisions related to mergers and acquisitions, capital structure, corporate governance, and other key aspects of corporate strategy and operations. Finally, the unseen power of hedge funds can also manifest in times of financial stress. During such times, hedge funds can serve as a source of market liquidity, helping to stabilize financial markets. However, they can also contribute to financial instability, as their trading activities can exacerbate market volatility. In sum, the unseen power of hedge funds lies in their indirect influence on the economy, their role in policy making and regulation, and their influence on other financial institutions and markets. While this power can contribute to economic growth and financial market efficiency, it can also lead to instability and raise concerns about market fairness and transparency. Understanding this unseen power is a crucial part of decoding the role of hedge funds in the global economy. As we draw towards the end of this exploration, it's important to revisit the significant points discussed and reflect on the overarching theme, the unseen power of hedge funds in the global economy. Hedge funds, as we've seen, are complex investment vehicles that pool capital from accredited individuals or institutional investors and invest in a variety of assets, often with complex portfolio construction and risk management techniques. Their structure and operation allow them to play a unique role in the financial markets, contributing to market efficiency, liquidity, and diversification. Their influence extends beyond Wall Street to the global stage, where they shape economic trends, play a role in economic crises, and impact developing economies. Their investment decisions can drive market movements, affect exchange rates, and impact the economies of entire countries. Moreover, their activities can lead to instability, and their influence can sometimes lead to market instability. The unseen power of hedge funds lies in their indirect influence on the economy, their role in policy making and regulation, and their influence on other financial institutions and markets. They can affect the wealth of individuals and institutions, consumer spending, business investment, and other key components of the economy. Moreover, they can influence policymakers and regulators, advocating for policies and regulations that are favorable to their interests. Finally, the future role of hedge funds in the global economy is likely to continue evolving. As financial markets become more interconnected and complex, the strategies and activities of hedge funds are likely to adapt in response. While this can bring new opportunities for growth and diversification, it can also bring new risks and challenges. In essence, the power of hedge funds in the global economy is significant and multifaceted. They contribute to economic growth and financial market efficiency, but they can also lead to instability and raise concerns about market fairness and transparency. Understanding this power, both seen and unseen, is crucial for anyone seeking to understand the complex dynamics of the global economy. As we conclude this deep dive into the unseen power of hedge funds in the global economy, it's clear that these financial juggernauts play a pivotal role in shaping our financial landscape. From Wall Street to the farthest corners of the developing world, their influence is felt in every transaction, every policy decision, and every market fluctuation. But our journey doesn't end here. The world of finance is ever evolving, and to stay informed, it's crucial to keep learning and exploring. If you found this content valuable and want to continue unraveling the complexities of the global economy, consider subscribing to our YouTube channel. By subscribing, you'll gain access to a wealth of content that delves into the intricacies of finance, economics, and beyond. You'll join a community of curious minds, eager to understand the forces that drive our world. So don't miss out. Click that subscribe button, ring the notification bell, and join us as we continue to decode the mysteries of the global economy. Your journey into the fascinating world of finance is just beginning. Let's explore it together.